Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, August 26th. I'm here with Shaun Burgess, Portfolio Manager, Crackerjack Municipal Bond Trader. We're going to discuss a few things that Shaun noticed or commented on to me earlier on interest rates today. Kind of interesting. Let's start off with you, Shaun. You know, for all the fireworks that were happening on the equity side, here you have the Fed talking about what they need to do to take inflation down, calm inflation, what they need to do with rates. What rates do today?
Long Treasury up, as you'd kind of expect off that move of equities, but for the week, largely nothing.
Yields down, long Treasury yields down, prices up. 10-year did nothing all week.
10-year did nothing. Short end really largely did nothing.
Interesting.
A really quiet week in the Treasury market. So this was really the most exciting moment we've had all week. Really influx into that 30-year, into the 30-year space off a bad equity day.
Yeah, you know, markets are always fascinating, right? If you had said a week ago that most of the talk out of the Fed today would be about having to be aggressive, raising rates, they're going to be consistent on that, you would have expected weak interest rate markets, each weak price markets, rates going higher. But maybe some of that's priced in. John and I and yourself have been talking about that 10-year, 275 to 350, 360, and how that range, if it holds, enables other markets to breathe. We'll see. You have a day in the equity market today. How much of that is a Friday in the summer versus people that actually believed that the Fed was positioning themselves next year for a pivot in cutting rates. Back on July, I think it was 28th on the video, I mentioned that if you're positioning yourself long equities because you think rates are getting cut next year, good luck with that.
You are putting the cart before the horse.
But you know, you see commentary after commentary talking about that. I think it's misguided. There are places to be in equities, and there's reasons to be there. You have small cap. We added a little small cap on Wednesday. Rallied beautifully yesterday. Got hit today. Small cap value. You start looking in the baskets that we own, trading at 8.5, 9 times, trailing 4 quarters of earnings. What that tells you is the market is pricing in such a deceleration of earnings that the forward number is more like 11, 12, or 13. That's your bet, right?
Yep.
Your bet is, if you're long small cap value, and that tends to be industrials, chemicals, basic materials, energy, your bet is maybe there's 9 PE, maybe they don't grow a ton next year. You have to be happy to buy at this 9 PE. Now, that's the fundamental side. On the technical or the supply and demand or the trading side, small cap value has traded very nicely. Broke through its 200-day moving average. The pullback's been shallow. Sure, got hit today with everything else.
What didn't today?
Be very interested to see how that trades. As you would have guessed, what got hit hardest today was pure growth. Now, pure growth is often reliant on markets to raise money to grow, right? Higher rates, more expensive to raise money. Inflation, the Fed battling inflation, trying to take the economy down a bit, hurts growth names more than value names. So we're going to try to stay barbelled there. Always try not to look at one day as a cause of any realignment. It's funny. 2 weeks ago, I was thinking to myself, geez, I have too much cash in the strategies. We're sitting on 25% cash in the strategies. Today, I'm like, I don't have enough cash.
You can't ever have enough when you want it.
The point is, it's a pendulum, back and forth in the equity markets and the fixed income markets. And back in June, we got so far to the defensive side, so far lightly invested in equities that the snapback was solid. And 2 weeks ago, we mentioned momentum had reached points that we're probably going to see a pullback. You had to be careful. We've got that pullback. We'll see what next week brings. What does the Muni calendar look like next week? I heard you say on a call earlier this week, it looks like it's filling up a little bit. Some municipalities coming to the market.
You know, we're seeing some real good deals. I think every time I'm on, I keep talking about long-term tax-free yields north of 4%. But that's really the area in the fixed income space that we just find the most compelling, especially on a day like today where you see that flight into long-term treasuries. That Muni at 4% just looks that much more attractive in this environment. And if you continue to see that economic weakness driving it, flight from equities driving it, I mean, those longer-term Muni yields where you can get them at 4.25, just look that much more attractive. So that's really where we're leaning into on the tax-free side of things. We like duration. We like those longer-term yields at those kind of levels.
Great. And you know, just because sometimes we get a message or a question, when Shaun uses maybe some jargon, that's everyday conversation for us, a flight to treasuries, a flight to long treasuries. Often, historically in the markets, when the equity market gets hit, the complementary trade is to buy long or 20 or 30-year treasury bonds, which causes them to rally. Demand causes those prices to rally. Yields come down. So when Shaun mentions that on the long muni, on a 20 or 30-year municipal bond, he can pick up a 4, a 4.10, a 4.15 versus what the 30-year treasury finish at today, a
318.
318.
Around that area.
You know, 80 basis points plus, tax-free on both Fed and state, where Treasury certainly, you have your state tax-free, but you're paying federal. Think about that after-tax return. So, good conversation. We'll see what next week brings. We're back into a traditionally kind of quiet period trading-wise, which can spark some volatility. I'd expect it'll give us some opportunities. That's all volatility. Volatility creates opportunities. We'll see you next week. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Thanks, Shaun.
Thanks, Matt.